Tampa Advisors. You have the floor.
Thank you. Hello, directors. We're Tampa Advisors. I'm Gobi. This is Abby, Johnson, James. First of all, we'd like to thank you so much for the opportunity you gave us to work with Chimes. We spent an immaculate time working with Chimes Financials. It's a great experience. We got to learn about the business economics and the historical financial statements. It was a fantastic time. What's important here is we'd like to address what the concerns you outlined in the memorandum. We'd like to talk about that. We'll go over in a minute before I'd like to set the agendas for the day. So the key important agenda that I want to identify is what the company Chimes works today, given the economics of the business. The second one is how are we going to solve the liquidity problem of the current shareholders. Abby's going to walk us through the important models that we can talk about it. The highlight is taking your questions and answer it in a way that it's going to be logical and intelligent. Abby?
So we used several models for valuing Chimes family stores. The first one that I'd like to talk about is the comparable analysis. And so when we did the comparable analysis, we looked at several companies, and mostly we took a list of retail stores, whittled it down to stores that either their balance sheet looks like Chimes family stores, or they're in the same industry sector. So the four competitors that we chose are TJ Maxx, Stage, Steinmart, and Buckle. Now, there's pros and cons to a comparable analysis. On the one hand, it gives you a great tool for looking at how the market is treating companies similar to yours. On the other hand, no company is Chimes. Chimes is, there's only one. So we have to take these with a grain of salt, and we look at a value range when we do a comparable analysis. We looked at several competitors before we whittled it down. We looked at four key drivers for the comparables analysis. And as you can see, the range of values that it delivers is quite broad, anywhere from $149 million up to $1.5 billion. So I wouldn't be doing you much of a service if I told you that we can say with 98% confidence level that the value of Chimes falls somewhere within that range. But of course, we're going to continue and hopefully deliver something a little bit more meaningful.
Thank you, Javi, for such a clear-cut definition and clarification. Now, we also decided to use the discount cash flow model to actually estimate the value of the company. We all know the pros and cons of the discounted cash flow model. One of the key advantage of the discounted cash flow model is that it helps to capture the intrinsic value of the company, so it helps capture the fundamentals of the company. And one of the cons of this discounted cash flow model is that it assumes the debt and equity of the company is constant. And also, to estimate the discount rate for Chimes, we decided to look at these key drivers, which actually helps us to arrive at the weighted average cost of capital for the company. The risk-free rate for the company is 1.96. The market risk premium is 4.62. That's the historical excess return of a diversified portfolio over the risk-free rate. Now, for the beta of the company, we took the average of the comparable beta for the company and took out the debt and equity from that beta to arrive at the unlevered beta for Chimes, and we added back the debt and equity of the company. Debt is 30%, the equity is 69%. As you can see, the equity is twice the debt of the company. The tax rate is 37.6%. The tax rate, we took the average of the tax rate of the comparables.
Although the current tax rate of a company looks like 46%, that looks like really bigger compared to the competition. So this may not be the sustainable number. So we took the 37.6 as a comparable one. In the long term, it may make sense.
The other thing that jumped out at us was the cost of debt. The cost of debt for Chimes was quite low. We used it in our WACC calculation because it is the actual cost that you're incurring. But we did test it, which we'll show you in the next slide, to make sure that the value that's delivered is consistent if that were recast in the future.
How'd you come up with the cost of debt?
We took the interest payment on the income statement, and we divided it by the outstanding debt. I think the interest payment is about $192,000, and the outstanding debt was $70 million.
Because I want some of that money.
Everybody wants
That was our first. That was our first take. So.
And then going forward, this is the discounted cash flow analysis for the company. As you can see, the total present value of the free cash flow discounted by the WACC gives us a 33 million value. When you add that to the terminal value, that gives us a total enterprise value of 230 million. As you can see, we assume the growth rate is going to be 3% because from what we read from the board memorandum, the company is a stable company. It's presently growing at a rate of 3.5. We believe in perpetuity going forward. It cannot exceed, it has to fall within the range of the growth in the economy. And also, if you look on the right side, you can see the sensitivity analysis that we actually ran on this company using two key drivers that drives the discounted cash flow model, the WACC and the growth rate. So you see in the middle, it shows you our value, and then you can also see the different values you can actually have with given the combination of the WACC and the growth in perpetuity. And now James is going to explain how the economic profit model helps to drive the value forward.
Thanks, Johnson. So now I'm going to talk about economic profit, which is our third model today. And the economic profit model will give us the same valuation as the discounted cash flow model, but it does so by different methodology. It really gets at the operations of Chimes. So it allows us to take a yearly look at the return on operating invested capital for Chimes over the cost of their capital. One of the drawbacks of using the economic profit model is that it's very sensitive to the inputs and drivers you put into it. So here's a look at our forecast for Chimes given the economic profit model, starting in 2016, ending in 2022. The economic profit is the invested capital times the spread, return on invested capital minus WACC, weighted average cost of capital. As you can see here, Chimes, year after year, is giving us positive economic profits. This is great. We feel like this is great for Chimes, and one of the reasons why we predict growth and feel great about the future profitability of Chimes. And to answer one of your questions specifically about whether Chimes is earning a competitive return on their capital, our answer to that is yes. Just this year, they're about 7% return on invested capital, slightly under that as an average through 2011, or since 2011, which is over their cost of capital.
Yeah, especially the average graph, like it looked like a little lower because given the 2013 and 2014 numbers were like really out of line. So ROAs you get like bogged down to 6.72. If you take that number out, ROAs you can look a little better instead.
So what's the value of Chimes? There's a third analysis we did for purchase by a potential private equity firm or a leveraged buyout. And we'll get to that in a minute. But all three values, as you can see, line up quite nicely. But as I mentioned before, it gives us a very broad range. And just, I don't think we'd be doing you a good disservice to say value somewhere between $100 million and $500 million. We looked at everything very closely. We looked at comparable companies and their market caps and things like that. And we feel that the value, the true value of Chimes falls somewhere between about $225 and $325 million. So would Chimes be attractive to a leveraged buyout or to being purchased by a competitor? We think it would, for all the reasons that we've named already. Both of these are viable options, but they do come with some caveats. So a leveraged buyout would entail a private equity firm coming in, taking the majority of the equity. They may be open to some people retaining some equity, but they are going to want control of the day-to-day operations. From your perspective, this is a cash deal, unless you stay. Selling to an existing corporation could be slightly different. They likely would offer a slightly lower price, but the option to retain equity would probably be greater. Again, you give up some control. So, and again, this is just what the deal structure might look like. We did run an analysis for what it would look like to have Chimes purchased by a private equity firm. We've given you a copy of that analysis in the packet. We chose a sale price close to the top of our range, about a little over $300 million. And at that rate, the private equity firm earns an internal rate of return of about 25.5%.
That still matches up with their internal criteria of like an leveraged buyout companies would require at least 20% in a 5-year given time IRR. Okay, so I'm going to identify the next important question, which is there a way out? We don't want to sell the business. How do you solve the liquidity issue? Yes, as we always have multiple options. The first, I would go with like an initial public offering. You can obviously take the company, private company, and take it to public, which the stocks become really liquid now. So whoever wants to stay, they can stay in the business. Whoever wants to get out, they can do so in the public market. Yes, it's a great idea, but it comes with the disadvantages too. If you look at the disadvantages, since so far the company is privately held, so additional expenses of running an IPO roadshows, that costs money, and regulatory hurdles and scrutiny of running a public company could be even difficult as well. So the next option I'm going to demonstrate is management buyout. Management buyout is a great option. Management has excess cash. The debt doesn't cost them money. They can borrow a little more, let's say $40 million at like even 5% or 6% interest expense. They can take out like about 15% of their current shareholders, provided the minority wants to go out relative to the majority want to stay in the business. That is also the difference. What if 50% wants to go out relative to 15%, the previous analogy that I mentioned? So it doesn't really solve the liquidity in a long term. Yes, it's a one-time solution. It's easy to do it now, but management, board of directors can get into a similar problem a couple of years down the line. So the third option that I'm going to propose, in our view, that's probably the best option. So Chimes can go ahead and buy a smaller, similar company. The criteria that I would advise is basically a company with a very low debt or negligible debt, or a company with great cash position, publicly trading in the market for very cheap price. So we took the liberty of coming up with a candidate to demonstrate how the deal might look like and how are we going to fund it. So this is a company, Christopher and Banks Car. They're mostly into women's apparel and accessories. Currently, presently the company selling in the marketplace for about $185 million. They have no debt. They have about excess cash, $50 million. Even if we pay 15% extra premium to the current market price, we would get a value about $230 million. If you take the excess cash out, the company comes about $160 million. So the company have to pay $160 million. How would they come up with the money? Given the combined company have a debt capacity to take on, we can do the LBO model ourselves. Instead of selling it to the LBO buyer, we can do it ourselves without putting the company in great distress. So this is the combined company is going to look like. So the new equity becomes $190 million. The new debt becomes $220 million. So we're asking you to issue $140 million at a 5% cost, which is doable. The 5% cost would only cost about $5 million. Given the operating income of $35 million for the combined company, still relatively very, very healthy. So now if you calculate the return on equity, it comes out about more than 10%, which justifies that buying an existing company in the public market can be a great deal, which solves the problem of liquidity as well, current as well as the long term. So here are the combined companies, like income sheet, like balance statement, how it would look like. So this is an option we put forth, like an LBO model we do. So although we understand this is a long-run company, we have a very long schedule to run, focus on the operations, you have an option. You can sell it to a private buyer potential at some point. So when you do that, we didn't really fund the deal with lots of equity. So additional thing on gravy, you're going to get like a hell of a lot of return if you look at the IRR in the presentation. So we're basically doing the LBO model ourselves.
Yeah. And we think that the IRR here is suspicious because we don't believe that, we don't foresee a disposition of CBK in the near future. So it's really a long-term hold, but together the companies have great synergies, and we think this is a good option because it gives the stockholders who want liquidity the option to trade their Chimes shares for CBK shares.
Thank you. So this is the part he was explaining about how the IRR could be really, really high if you did the LBO model, because our current equity relative to the future equity that we put in, the returns are going to be magnificent. But even though we don't foresee that model to be happening, but we still want to show it to you what the potential may look like. Or you are definitely asking for recommendations, right? The recommendation is solve all the problem that we have. Are we going to nurture the business, grow the business? How are we going to identify the liquidity problem? And what is our company maybe worth in the future? If you do the LBO model, it's great over the long run. Existing shareholders who wants to stay, they get the immense benefit. As shareholders who wants to get out today, they have the easier option of going, using the same stock and selling it in the marketplace. This solves the liquidity issue immediately overnight. And we haven't even accounted for the cost synergies and economies of scale of the combined company, which could be a great number over the years. Given the company has like CBK, that's very well managed in terms of capital position, it could be a great option. Thank you so much. And we're open to questions.
Just a quick question. I'm intrigued by your LBO option, but it seems that it's going to impose a lot of risks on the company's financials going forward, because our strategy so far has been to retain a lot of cash, buffer downturns, and that's why we carry a lot of debt. Our net margins are about 2% at best. So I'm a little concerned that the additional debt may send us into negative cash flow in the future if we follow that model.
The interest expense that we projected, 140 million, we consider the 70 million stays there, 140 million additional interest that the debt that we're going to issue, let's assume like 5% or 6% even. 5% number comes out to be $7 million on a 140 million debt load. If you looked at our operating earnings projection, it's not out of the line. It's still the projections are still on the line of revenue growth. Expenses are the same percentages. It comes down to like 35 million. So it's 5 times higher than the interest expense itself. Even though it looks like a really LBO model, but it's a very conservatively done LBO model. Because if you look at the regular LBO,
the way that we structured it is that the Chimes would use all the excess cash in the beginning years to quickly pay down the debt. Therefore, you're only carrying that debt load for a few years.
Yeah, you can look at the LBO model. We pay the prepayment rate of immediate, so that we don't really foresee that to be a really risky option.
Why borrow the debt if you have the free cash that you're going to use to pay down the debt?
We don't have other option today. If we are buying a company, how are we going to buy it? This is not a public company. We can issue shares. This is a private company. We have cash
We
in
have
hand,
cash
yes,
in
we are
hand.
using that as well. That's the buffer part I'm talking about.
Yeah.
If we are provided the industry, today, the debt market is really, really fluid. It's easy to borrow money at a very low rate, so it's appealing to do that
And
without putting
we
the company
maintain
into
a
distress.
minimum of cash on the